Hey there, everyone. Welcome back to the Caderna podcast. I'm your host, Brian Caderna. In today's episode, I'll be sitting down with Stephen Foerster. And before we dive in, let me give you a quick bio for some of you who may not be familiar. Stephen Foerster is a professor of finance at the Ivey Business School at Western University in London, Ontario. His latest book, Trailblazers, Heroes, and Crooks, subtitle Stories to Make You a Smarter Investor, is from Wiley and came out in September of 2024. His prior book was In Pursuit of the Perfect Portfolio, the stories, voices, and key insights of the pioneers who shaped the way that we invest, with Andrew Lo and the MIT Sloan School. It was featured in Wall Street Journal's bookshelf column and won the Axiom Business Award Silver Medal in Personal Finance and Investing. He's currently writing the authorized biography of William Sharpe, the 1990 recipient of the Nobel Prize in Economics, which I'm sure we'll talk about today. Foerster has served on pension and endowment fund boards, as well as not-for-profit investment committees. He received a PhD in finance from the Wharton School at UPenn and has obtained the Chartered Financial Analyst designation. He was the founding co-director of Ivey's Women in Asset Management program. But without further ado, Stephen, welcome to the show.
Glad to be here, Brian.
Yep, I always say it's a good time to talk investing, and it doesn't matter what time it is in the economy. Always seems like we have a bit of chaos to be dealing with.
I think we always are living in interesting times.
Yes, yeah, well said. And maybe almost as kind of a launch point here, you see so much follows the American economy. They say if the U.S. sneezes, the world catches a cold. You hear all these different kind of, sayings out there. As we have Trump and Kamala debating coming up next month, we have an election just a few months away here. What would you say an election year really impacts the markets? I know I have some stats on the issue, but I just would be, interested in your take.
Yeah, I've actually done a little bit of research on this quite a number of years ago. There's certainly something to the so-called presidential cycle and how the markets do in each of the 4 years of the cycle. Usually the last 2 years tend to be better, years 3 and 4. In particular, year 2 has historically been the worst year of the cycle. So something just to keep in mind going forward.
That's interesting. And, anything, and obviously as a financial advisor, I feel like every piece of advice I ever have to give or anything I have a client sign, it always says at that bottom, that famous footnote that, past performance is not an indicator, or past history is not an indicator of future performance. Do you put much weight in some of the cycles that you see, whether it's on presidential terms, times of the year? I know you hear a lot of speculation about, certain months are better than others. And I think once you get kind of like a long enough string of data, people want to follow that and say, historically, this is the trend. Do you think following trends is wise, or is that kind of a setup?
Well, I think this will come out in our conversation because a lot of the theme of my most recent book is encouraging investors, along with their financial advisors, to think about an investment philosophy. And hopefully some of the mistakes that I have made will be helpful to readers in terms of developing their own investment philosophy. Just to give an example, to pick up on the election cycle, I did try to take advantage of that in terms of my pension money. We have a defined contribution plan, and so this was years ago when it was year 2 in the investing cycle. Knowing my own research, I thought, okay, well, I'll park my heavily equity-focused retirement fund in cash for a year. Turns out that was the worst thing to do at that particular point. So this is where certainly I can identify what's happened in the past, but to your point, that's not necessarily indicative of the future.
Yep. And I think the kind of investment philosophy is so important for people to get on board with. So maybe even if we take a step back, can you give some insight, just going back to almost the genesis of how you got into this business and, where the passion for investing came from and kind of ultimately how you came up with your own philosophy?
Sure. So when I finished my undergraduate studies, I had an opportunity to take on a 2-year contract at the same institution that I ended up with for the last 37 years. And I found I liked teaching, so I wanted to make a career of it. And so I decided to do a PhD, and fortunately, UPenn, the Wharton School, somehow accepted me. And so
Yeah.
after that, then that's when I really got into my love of research as well. And what really attracted me was capital markets, the stock market, from an empirical perspective. And so much of my research in the past 4 decades is just trying to figure out what makes the markets tick more at a macro level rather than at
Mhm.
individual. And so that's sort of been my fascination, contributing hopefully in a small way to that literature, but also appreciating what others have done as well. And so a lot of that helped to inform my investment philosophy. Plus, as I mentioned, some early mistakes that I've made, and we can talk about some other mistakes I've made. And so I have a particular philosophy, and I could summarize it fairly succinctly. The book is not meant to say you should follow my particular philosophy, but it's more you should develop your own philosophy, often working with a financial advisor and coming up with that particular philosophy.
Okay. Yeah, and we'll definitely get into that. And maybe again, just at the starting point, could you share with us perhaps what your first investment was?
Most of my investments have been more on the fund level and through my pension fund. One of the early individual stock investments, and it's been very rare for me to make individual stock investments. It was actually through derivatives, and it was shortly after Google, now Alphabet, had its IPO. And what I'm sharing with you is probably my biggest mistake in retrospect, but it helped to inform my investment philosophy.
Okay.
A lot of the research, and I contributed this as well, shows that companies that have gone through IPOs, day one is often great. The average pop in the stock price is about 15%. But if
Mhm.
you get in after that, if you're not part of the family and friends and you get in at that IPO price, the research suggests on average that IPOs in the next 3 to 5 years tend to underperform the overall market. So knowing this, Google had recently IPO'd, its stock price was way up. So I decided to make a long-term bet against Google. And so I effectively bought put options, 2-year put options, betting that the price at the time of Google stock would go down. And I was dead wrong on that. I
Google's done quite well.
I should have done the opposite. And,
Yeah.
and that helped to inform my philosophy of it's really what I came to believe, and others can believe. You might believe something different. I believe
Mhm.
it's very difficult to outperform the market, and so my perspective has been to buy and hold, generally taking a very diversified portfolio perspective, index funds, and so on.
Got
I,
it.
I just look back at it, and here's where you can actually quantify mistakes. This would have been about 20 years ago. And
Mhm.
it was a $10,000 investment. Had I taken that money and put it in an S&P 500 index, uh, that 10,000 would probably have been worth around 70,000 now. So that mistake has snowballed, and when I think now, I love to travel. What I could do with $70,000 now,
Yeah, right.
yeah, I want to travel.
Yeah, I bet. So, I mean, a couple follow-up questions on that. first, I know it sounds like you were going off of some of the historical data. Usually the IPO pops quickly, and then more often than not, kind of has a pullback. And it sounds like you were kind of following that historical data. Was it just purely on that, or was there something about Google that you did not like at the time that maybe confirmed you're pulling the trigger to buy those puts? And then
So,
secondly, I know you shared a little bit of kind of what you learned by that. It sounds like that you learned to kind of pursue more indexing. Could you share maybe what else you learned from it?
sure. It was mainly based on that, those overall results that I was familiar with in the literature. Uh, I,
Okay.
I did not do a deep dive of fundamental analysis, looking at Google, looking at what then was an emerging industry. And so, if anything, I think it was a little bit of gut feel, which again is something that I learned not to trust my gut.
Mhm. Okay. And so it was kind of like you got unlucky. You had just picked a company that actually did shine and go on to do great things.
Correct.
Um, yeah, which happens. We have ups and downs with that for sure. And so when you got into the investing world, were you, or did you do a lot of investing? Maybe we should start there. I know you did a lot of research. I know you're a professor. Do you have kind of hands-on either on personal portfolio clients or managing endowments or anything to that effect? Or are you more providing academic support to those folks out there?
It's more the latter. It's more providing academic support. I have been involved in endowment funds and even to this day, pension funds at a more of a macro level on various boards. So not making the individual decisions, but
Mhm.
an oversight role. And that has helped me as well to inform my beliefs, to take a look at how external managers have performed and how tough it is for many of the professionals to outperform. And that's not to
Yeah,
say that no professionals can outperform. My book talks about Warren Buffett, and certainly his long-term track record at Berkshire Hathaway has been exceptional.
sure.
The challenge, can I tell you today, or can I find a new Warren Buffett among managers? I think that's a tough thing to do.
Certainly, yeah, it is. And I guess what some people, like if they're listening to this show and they're saying, well, I'm not really in the business, I just know of the periphery of the investment world, and they're hearing a lot of what you're saying, that, I mean, obviously there's just such a huge industry of studying the markets and professional asset management. And then so many often draw a conclusion, it sounds like what you have, that you can't really beat the market. It's, more of that, just participate in the market. Why do you think that there is just such a enormous amount of study and investment of dollars and times in trying to figure it out, when so often it seems like the brightest and best minds come back to like, hey, we did years and years, decades of research, and we found out that you can't figure it out?
Because buying and holding long term an index fund is boring. And so, what you bring to a cocktail party is going to be boredom when you share that story that you are a long term buy and hold index fund investor. It's
Mhm.
more exciting to pick individual stocks, or to pick fund managers that you think are going to outperform and have great stories. In the last 3 to 5 years, we've seen some great stories in terms of the so-called Magnificent Seven and
Mhm.
what generative AI might bring to the table. And that's not a new story. We can go back to the what in retrospect we call the internet bubble. We can go back in the late 1990s, early 2000s. We can go back to the so-called Nifty 50 in the 1970s. Stocks that had all kinds of hype um, didn't end well.
Mhm. Yep. And I think as you kind of take a deeper dive into this industry, where I find my value as a CFP is going back to Warren Buffett. Like you said, I know one of he has so many famous sayings, But one of them I love is it's not how your investments behave, it's how you behave with your investments. And I truly feel like that's my job. Like I do create and manage portfolios, but then interacting with these clients on a daily basis, honestly, just to get them to let the thing do the work is half of my job, frankly. But then when you go up to more of, off of kind of the retail side to more of the industrial side, maybe we'll say of like hedge funds, I struggle with their value there because I feel that so many of them do have a long track record of high fees that everybody's aware of, and so often underperformance versus the index or the benchmark. Yet there is this, is it just purely an allure to the story of, someone very wealthy saying, hey, I got into this club that other super wealthy people got in and will gladly pay extra fees to be a part, and then to not even do as well as, putting $100 in an index fund that a college kid could do.
Well, let me turn around and ask you, you're at a cocktail party. Who would you rather talk to? Someone who is investing a buy and hold index fund investor, or somebody who's gotten into a hedge fund that not many people have been able to get into? I'd love to talk to that person. They sound more exciting. I don't know how their performance will end up, but
Yeah.
a good story. And that's the danger. That's the danger. And going back to what you mentioned, I couldn't agree more that and I have a financial advisor as well. And I think one of the biggest value adds of a financial advisor is providing emotional support and helping your clients to not make those crazy emotional based mistakes.
Yeah, it's so true. And it's been even a journey on my side. I started in 2009, and I get hit up every day, frankly, with new investment ideas, new firms, new third-party asset managers, you name it, funds of funds, and the list goes on forever of people trying to recreate and rebrand something new. And as I've gone further in my career, now 15 years in, the amount of simplifying I've done is crazy. I mean, it's almost like you came full circle. If you just learn and you absorb so much of this stuff, and you try different things, you try and implement these different concepts or these different tools, and I feel like you kind of just come all the way back around to like, hey, how can we really boil it down to have an efficient, easy, I think one of the biggest things is easy to understand approach, so that I can in 2 seconds, say to a client, this is what we're going to do, and they're either on board or they're not. Where I feel like, I feel like I'm kind of bashing my own industry here, but we just baffle people with just this endless amount of information. I mean, what's your take on that? Do you think there's ever going to be a push in the industry just to purely simplify, or is there some kind of ulterior motive to creating this gigantic cloud of information?
Well, I couldn't agree more. I think it really boils down to keep it simple. And that's where, and again, this is my own investment philosophy. That's where I can't imagine anything more simple than a traditional index fund. By that, I mean something that invests in a well-diversified portfolio of stocks like the S&P 500. Of course, we're talking in an American context, but thinking more in terms of a global index fund as well. And so I think this is where, yeah, and you're absolutely right. You see things that appear to be new, and yet what's new is not necessarily new, and that's where I think an appreciation of history gives us a sense of that as well.
Sure. And so I guess maybe kind of coming back to the beginning of our conversation of the current day, and just looking at maybe some kind of impacts on the markets. Right now, obviously, at the forefront probably is the upcoming election. I just wanted to get your take on, if you look at a lot of the data that I've seen, it's that election years are usually pretty good. And it doesn't really matter so much whether it's Republican or Democrat. And you find people that are on either camp, and if they hate the other side, they make investment decisions based on that. And then they end up getting hurt, by kind of letting that emotion take control. My question to you, I guess, is, do you see like that a president, an administration can have such an impact, positive or negative, on the markets versus like what so much I feel like they're just kind of riding on the backs of the Fed. And that's saying, don't fight the Fed. When they decide to raise or lower interest rates, like I feel like it's easy to see that consequence. Can you talk at all about kind of how the two go together, or what an investor should maybe pay mind to or not pay mind to?
I couldn't agree more that I think presidents take too much credit for what happens in the economy, and conversely get blamed too much for what happens in the economy. And if there's one factor that impacts on stocks, and who has the most influence on that, that would certainly be, I think you've nailed it. It's interest rates, and so it's what the Fed does. It's what the committee, but primarily the chair of the Fed, what direction they are looking at. That's going to impact both on bond prices and on stock prices, and so interest rates really matter.
Yeah, that kind of guides the way. But what about, like, I mean, you think of something kind of from like economics 101, where say we have Trump coming in saying, again, I'm going to keep taxes where they are, or I'm going to get even more tax cuts, devised for my next term. And then you have someone like, Vice President Harris coming in saying that she wants to up the corporate tax rate. She wants to create new taxes in addition to that. When you start to see all that, some of her proposal, and I don't know it inside and out yet, but I know she's talked about taxing unrealized capital gains and then increasing the capital gains tax rate significantly. I would imagine that does have an impact on investor emotion. And also, when you see something like that that's particular to your portfolio, like the capital gains tax, my natural inclination, if I see that can go through the roof, I think most advisors are telling their clients, okay, we need to start kind of locking in some of these gains before they get hit at that much higher rate, which can create kind of like a downward spiral. Do you think things like that have an impact, or is it still just kind of the Fed there behind the scenes saying, hey, we got this?
Sure, absolutely. I think it has an impact. And looking at the previous Trump administration, probably the biggest impact that he had from an investor's perspective was lowering the corporate tax rate by a substantial amount, and so that matters to the markets. If we look at it from an individual security, an individual company's stock perspective, it's all about cash flows and the expectation of cash flows. So clearly, we can see a direct connection. If the corporate tax rate goes down, that's going to mean more cash available to the investors in the company. And so on that micro level, that's a good thing. And then if we aggregate that across all U.S. companies, then the market as a whole should get bumped from. So that's on the one side. Now, another factor, clearly, as we've talked about, is interest rates. Because interest rates, if we think of what goes into the value of the stock, and I talk about this in the Trailblazers, Heroes and Books as one of the examples with Bobby Bonilla's infamous contract. It's really, we value a stock by the expectations of the cash flows discounted back to the present. What is that dollar that I'm expecting a year from now, 2 years from now, and so on? What's that worth today? The lower that discount rate is, which is tied into what the Fed rate is in some way, the lower that is, then the more value that stock has. And so if interest rates go down, that's a very positive thing for the markets as a whole, and vice versa. So again, we're back to interest rates as having a big impact. Mm-hmm. From a political perspective, where you have different candidates claiming that they're going to come up with different policies, some of those policies might be interpreted as inflationary. And if those policies are inflationary, we know the experience in the last 5 or so years. In an inflationary environment, the Fed is going to try to get inflation under control by increasing interest rates. So there you have sort of an indirect connection in terms of the presidential administration policy if it is going to be inflationary, then that might lead to higher interest rates, which would be a bad thing for stocks and bonds.
Correct. Yep. As we kind of discuss this, it almost seems like I'm envisioning like this scale where you have the politicians on one side, and if they do something that, would be deflationary, they say, hey, we're going to suck money out of the economy through raising taxes. Then it's like you have the Fed on the other side, like, okay, we'll just drop interest rates a touch. And it just continues to kind of balance itself. And then, yeah, like you said, then the politicians jump on the pro or the con of whatever that result is. So it's very interesting. And I guess just one other question I have on that, if you could comment, when you hear so much talk about, you see sometimes maybe the Republicans are saying, look at what we did with the stock market. Go check your 401k balance. And they'll brag about it. Sometimes you might see more on the Democrat side where they'll say, look at those people with their 401k balances. What about all the folks out there that don't even have a 401k, that are just going to work every day, trying to get a paycheck so they can get to the next one? Does a rising stock market help everyone? Or is it something that's only helping the affluent and the investors, where it doesn't really trickle down to the middle or lower class?
So it certainly helps anyone directly who has a direct investment in the stock market.
Sure.
That's clearly the case. It helps anyone who has a corporate pension plan. It might be more of an indirect connection for those who happen to have the old style defined benefit plans, because the better the stock market is doing, then that pension plan is going to be in a better situation, more chance that it's going to be in a surplus, and so that's a good thing for the workers. So it can be either direct or indirect. There's another way that it also impacts. Obviously, if your portfolio, if you have stock investments, you are wealthier. That could also impact on how you consume, which again could directly be related to the economic performance. If I feel, even if I'm not spending my retirement money now, but if I feel wealthier, I might be more confident to spend now, to consume now, which will keep the economy going, which will help with jobs and so on. So it's sort of a virtuous circle as far as that goes.
Mm-hmm.
And so it can have direct and indirect impact on those that do and don't invest directly.
Understood. And I want to get into your book in just a moment too. But just as we're kind of in this like general overview of the economy right now and the stock market, another question I have that I hear a lot about, there's a lot of conversation about it, obviously, is our national debt. You look at the U.S. federal government, the outstanding debt balance right now, I think is just north of $35 trillion. You just talk about these massive, massive sums that the average Joe, they have no idea what that balance is. And it's hard to even fathom, like, well, what does that mean? And then you talk about interest rates and the correlation there between, well, if rates go up, that could be a more costly debt and vice versa. What does that debt matter? Because then you hear all this kind of fear mongering, and then you hear some economists say that it doesn't really matter. It's just this number out there. Let's just see how the economy's doing this year. Do we need to pay attention to it?
So, yes, absolutely, we need to pay attention. Does it matter on a day-to-day basis? Probably not. The danger is that once the debt relative to GDP, and that's often a very important metric, because it really boils down to how sustainable that debt is through the interest payments that make up a portion of the budget. And so the danger is that if a country reaches a tipping point in terms of their debt to GDP, and some people have tried to quantify that, what is that magic number? And some have come up with, I believe it's something like, once you get to 90%, then it could be a danger. But if then at that point, investors start to pay a lot of attention to it, and that's where it can have a really negative impact, because that's where the debt can become more expensive. The world,
Yep.
in some sense, is lending to the U.S. government by and large. Obviously, Americans are lending as well. And at the moment, with relatively low interest rates, that's still not a problem. But if investors globally say, hey, I only want to lend to the U.S. at a higher rate, then again, we get back into this cycle we talked about. Rates would have to increase, and that can have a huge negative impact on the stock market. So it's not something that we're going to wake up tomorrow and it's going to be something that everyone's going to panic. But you will get progressively closer and closer to some unknown tipping point where everyone starts to pay attention.
Yep. Yeah, and just, I mean, I'm pulling up a chart here too as we discuss this. Like if you look back towards like World War II, that's when we were previously very, very much near a high. You look at gross federal debt to GDP was right at about 120% leading up to 1950. And then it steadily dropped all the way, I guess, towards like about the Reagan years, like 1980-ish. And since then, we have had an explosion. And as we speak right now, we're over 120. So, like you said, that there can be kind of that alarm button, that economists look at if we go over 90%, debt to GDP. We're way over that, where our debt is exceeding GDP. And it's been that way, for a few years now. Like what is it? Doesn't seem to be any alarms.
Well, Brian, this might test your powers as an influencer. Maybe those watching this show will start to panic, and then we'll have something.
Yeah.
The message is that we are in a danger zone, and what will trigger this, who knows? But the chances of things having a really negative impact are much higher at this kind of a level of debt to GDP than if we were in a much lower circumstance. So, it is something that's going to need to be addressed. I don't think either of the major political parties are tackling this. It doesn't seem to be.
No, not at all.
Yeah, which makes it even more concerning.
It does. And some things I've heard, just when I've brought this up and talked with folks, is that it's almost like the U.S. can be the tallest midget in the room, where, if we just look at this and we don't attach anything to it, we're like, oh my gosh, that's a pretty dire picture there. But then when we say, actually, that's the United States, and then we look at the rest of the globe, we say, okay, well, everything's relative. And for that reason, we don't need to panic because we're still kind of king of the jungle or right there with China. You can make the argument. I mean, I don't know if that's really any question, maybe more an observation, but, and then with the interest rates, that's what I had always heard, is that with this gigantic balance, if rates go up, then it'll be panic time. But then we just saw we had the fastest, interest rate hikes in 4 decades. And I don't know. It seems like everything's still moving along okay.
I think it really boils down to confidence in the dollar and whether globally other countries still see the dollar as a safe haven and want to hold dollars in terms of central bank reserves. Again, if you get to a tipping point and there's more of a reluctance to hold dollars, that's where things could potentially start to unravel.
Got it. And so that's just ultimately a lack of faith in America.
Absolutely.
That's the fear. Okay. All right. Good to know. And so I want to pivot a little bit and ask you, excuse me, a little bit about your book here. You talk about obviously the classic 60-40 portfolio, equities, bonds, making up a portfolio. Can you talk about bonds? Because I've had this discussion with clients too, and I've even had a lot of these conversations with our compliance officers that look at fixed income and they say, okay, it's fixed income, it's bonds, that falls into our conservative pie. And I've made the argument, because we have seen, especially in recent memory, that fixed income does not mean fixed, and that you can lose money there. Sometimes you can lose more money there than you would in the stock market. Can you just talk a little bit about the role that bonds play, and maybe some sort of future outlook on them?
Sure. So an important distinction, I think, is in terms of government bonds and non-government bonds or corporate bonds. And in the book, I talk about the origin of government bonds, which goes back to 12th century Venice. If we're talking about U.S. government bonds, despite our conversation in terms of worrying about the debt to GDP, by and large, the U.S. has never. There's some technical defaults, but the U.S. has really never defaulted on its obligations. So we should think of government bonds, in particular U.S. government bonds versus Russian bonds, let's say, or Greek bonds, as being risk-free. What investors need to recognize, just on the government bond side, before we talk about corporate bonds,
Sure.
is that when we talk about something being risk-free, there are two elements there. That we're talking about holding to maturity. And so things can change in terms of if the interest rate environment changes as I'm getting coupon payments, the rate at which I'm going to reinvest those coupons is going to be changing. So although my principal is guaranteed and safe, then I still have some uncertainty in terms of the reinvestment rate. The other element, again, in nominal terms, I'm quite comfortable in buying a 10-year, a 20-year US bond because I'm very confident, virtually 100% confident, I'm going to get for that $1,000 bond, I'm going to get $1,000. But there's the inflation uncertainty. What that $1,000 is going to buy me in 20 or 30 years from now, that is an issue. So that's one component. Even though we can think of U.S. government bonds as being risk-free, there's still those two elements that we need to take into account. So the other aspect is whenever we're talking about corporate bonds, then there is a risk in terms of, am I going to get my money back at the maturity date? And so you're absolutely right. We have to be careful just talking about fixed income as a category. We have to be very specific in terms of whether we're talking about government bonds or whether we're talking about corporate bonds. And so the other thing is just in general, what even bond investors sometimes have a hard time grasping is that there is a negative relationship between interest rates and bond prices, meaning that if interest rates go up, bond prices will go down and vice versa. So that means that if I'm not holding a bond to maturity and interest rates go up, then I can actually lose money on that bond, whether it's a corporate bond or whether it's a government bond as well. So long story short, absolutely there is risk in bond investing, and it's directly tied to whether it's government or corporate bonds, and also whether I'm holding to maturity or not.
Just to elaborate on that, if you could, for our listeners, do funds often hold to maturity? And the reason I ask that is if you look at recent memory, forgive me if I get any of the years wrong, but 2022 is the year where you couldn't hide, if I'm following all the different returns correctly. And that was a time where someone could say, okay, at the time, maybe if I bought a 2-year treasury, okay, I was getting 2% then, where now I'm getting close to 5%. Bottom line, I'm hearing the safest investment in the world of a U.S. Treasury, and I'm just hearing positive rates, whether it was 1%, 2%, or now 4 or 5. I think just the layman would say, okay, well, you can't lose there. But then if you bought a particular fund that was largely made up fixed income and the bulk of that, U.S. federal debt, then they look at that in a year like 2022 and they can see a negative. And they're looking throughout the year and they're saying, why is it going down? Like, I own this fund. I don't understand where now I'm down 2%. Now I'm down 5%. Like, what the heck is happening? Can you kind of clue that in, like where that differs between holding the actual bond versus holding a fund of bonds? And you can see that in years like that, like in 2022, the returns can be so different.
So you picked a really interesting year, and to go back to the 60-40 example, which is again a sort of a classic. I've actually looked into trying to uncover when did this start and who started it. It's not clear who started the 60-40, but it goes back to the early 1960s. And so the notion here is to have a balanced portfolio tilted towards stocks, because stocks over the long run in the U.S. context have done better than bonds. And a 60-40 portfolio has done very well in terms of risk and return over a long run. There have been exceptional years on the downside, and 2022 was one of the worst on record, in which both stock prices and bond prices went down fairly substantially. So to your point, why did we see negative bond returns, even if I had a portfolio of, let's say, long-term government, U.S. government bonds? And the answer is that if I'm a fund, we need to do a valuation at the beginning of the year and at the end of the year. So even if a fund hasn't sold, we still have a secondary market for that bond. And what those bonds are selling for at December 31st versus January 1st of a particular year really depend on what's happened to interest rates during that year. So that's what happened. Even if these particular funds are buying with the intent to hold these securities to maturity, we have to do a valuation at certain dates. And so that's where it might be paper losses, but those are real if you as an investor want to sell out on December 31st.
Got it. So, I mean, would you say, and I don't know, I have a lot of compliance oversight. That's why I have to reserve some opinions just so everyone knows on the show. I'm sure they probably already know. But for yourself, what you are allowed to disclose or not, as far as your own take on things, someone who's saying, okay, right now I'm looking at fixed income. If I can go buy a 1-year treasury and a 2-year treasury and build a little ladder for myself in the 4 to 5% range, and they know I definitely don't need to touch that money for a year or 2 years, would it not behoove them to say, okay, I'll do that rather than take those same monies and say, let me go buy a bond fund? And now technically it's not guaranteed. Like, yes, it's conservative in air quotes, it's fixed income. But if I need to take it out in a year or 2 years, I'm not getting a stated rate of return like I would there, or a CD or a fixed annuity or something.
So I think it really depends on a lot of factors. In some sense, it really shouldn't matter in terms of whether you're trying to do this on your own and building this laddered portfolio where you're buying each year and contributing to that portfolio. So maturities will vary when it's time to sell these bonds. That probably effectively is what a lot of fixed income or bond funds are going to be doing. So a lot depends on your own personal situation, and this of course comes back to know your client and what kind of liquidity needs does your client have, or are they needing this money in the next year or so, and that's how you want to perhaps structure it. If this hypothetical client is planning to stay in fixed income, for example, over a longer period of time, let's not forget that if they're buying a 1-year or 2-year bond that might look more attractive in the short term than buying a 10-year or 20-year bond, which might actually, we're in this unusual world where a so-called inverted yield curve where longer term rates are in some cases lower than short term rates. But you have to keep in mind that then you have to ask yourself, what am I going to do in 1 year or 2 years, and what will interest rates be at that point? There's a different perspective which says, you know what, that's going to all come out in the wash. So yes, buying a 1-year or 2-year now might look better, but then you're going to have to reinvest it. And so these other bonds might be similarly priced over a very long horizon.
And just kind of another angle to attack that from, you mentioned the inverted yield curve, which I feel like for so long was like, what the heck is that? It never happens. And now I feel like it's the norm. Like it's been that way or close to for a good while now. Is that just simply suggesting that in the near term there's worry, or there's not worry, and in the long term there is, or vice versa? Is that kind of what that's implying when you look at like a 2-year outlook versus a 20-year outlook?
So let's just step back and unpack a little bit. First of all, I think for your listeners, just trying to define what we mean by an inverted yield curve. You have to put a stake in the ground, and oftentimes it's looking at the difference between a 10-year U.S. government bond yield today and, let's say, a 2-year bond yield today. Others would compare it to a 3-month. So you have to have a definition of what we mean by an inverted yield curve. But I think whatever metric now, we would see some inversion. What historically has been the case is that empirically, when we see an inverted yield curve, by and large, there tends to be a recession in the next 6 months to 12 months. However, this is the rub. Sometimes there are inverted yields that are not followed by recessions. So again, flip it around. In I believe every occasion since World War II in the U.S., if we look at a recession and then go back to see was the yield curve inverted, the answer I believe is yes. We'd have to do some fact checking on that. But the converse is not true. There have been times when there have been inverted yield curves that have not led to a recession. And I think Nobel Prize winner Paul Samuelson, I think he was famous for saying the yield curve has predicted 15 out of the last 10 recessions, meaning there are a lot of false positives as well.
Yeah. It's like that kind of all squares are rectangles, but not all rectangles are squares.
That's right. Yeah.
Yeah. Very interesting. And just to kind of round that out as we're talking about the equities versus bonds, what's your take over the long term? Because I think if you just look at a chart, again, if you remove all the noise and everything else surrounding it, and you look at a chart of, say, the Dow or the S&P 500 over a 60-year period, okay, and then you pick whatever bond metric you want and stack it next to it, it's almost like a joke if you look at the returns next to each other. And the reason that I bring that up is especially if I'm dealing with someone that has a long horizon or a young professional, and we go through these risk tolerance questionnaires and things, get a feel for that as we have to do with compliance. And if they come back and they're saying, oh, on a 1 to 10, I'm a 1. I hate to lose money. It gives me agita. I get sick to my stomach. I never want to see that up and down. I almost feel bad for them because I'm like, the amount that you can miss out on in the next 30 years could be astronomical. And if you can just kind of put the blinders on and stay the course, at least that's what history has shown us, is what the stock market could do for you. Do you feel like you're trying to educate people a lot like that to get comfortable with equities, or what's your view on that?
Yeah, absolutely. And this is where in Trailblazers, Heroes, and Crooks, I tell the story about the worst day in U.S. stock market history, October 19th, 1987, and what happened afterwards, which was a tremendous rebound. So we need to be aware of the risks in the market. In terms of stocks versus bonds, and certainly stocks in a U.S. context, not in every country, in every country's stock market histories, but in a U.S. context, stocks have done well in terms of the last century plus, although there's some new data that's been uncovered going back many centuries. And the picture is not so much of huge outperformance of stocks versus bonds. So it's a little bit more nuanced as we go back a long time period. I would say for your clients and for investors, particularly for bonds, it really depends on your starting point. I wish in hindsight I could go back to around 1981, where interest rates were extremely high, and thanks to Paul Volcker, the Fed chair at the time, worked really hard and inflation was high as well. So he worked really hard to bring inflation down, which brought interest rates down. And that really fueled this huge bull market that lasted decades. Had you bought bonds, long-term government bonds at that point, which had these astronomical double-digit yields, you would have done phenomenally well because, again, this inverse relationship, interest rates come down and bond prices go up. Fast forward to the last couple of years, and we're no longer in that scenario, but where we had near zero federal funds rates, even long-term rates, extremely low, long-term government rates. That was not a great environment in which to start being a bond investor. Now things have more normalized, and so with long-term government yields, I believe in the 4% plus range, that's more of a normal scenario, and so that's where looking forward, you can expect there to be, unless back to these macro factors and the geopolitical factors, unless we really are concerned that interest rates are going to go up, that we're in not a bad environment. Last thing I would say is that this whole notion of diversification, and we've been talking rightly so about traditional investment stocks and bonds. This is where, going back to something like 60-40, in theory, the bonds should act like a shock absorber. We didn't see that in 2022, a very exceptional year. But this is where, if stocks have a bad year, usually bonds are not having as a terrible year as 2022 was the exception, and so that takes the sting out of the bonds. This goes back to Harry Markowitz that I talk about in the book back in 1952, who really showed us in a systematic manner how diversification pays.
Sure. And I know we're kind of spending some time on this, but there's another question that pops to mind. When people think of kind of that balancing act of equities and bonds, and that would be the shock absorber, but then 2022 says, hey, guess what? It's not. You're still flying without brakes and kind of crashing in that year. Where do maybe commodities play a role? Does that ever enter as perhaps a substitute where someone might say, okay, I'm going to use equities, I want to get all that upside, but then let me buy gold or silver so that if things do go haywire and the Fed starts to play with interest rates or what have you, now I'm not getting hit on both sides of bonds and stocks, but I have just kind of this other thing that maybe operates in a different way. Do you see that apart as a portfolio? Do you study that much?
Yeah. So absolutely, anything that is not what we would call perfectly correlated is a good thing, and that's really, as Harry Markowitz put it, really the only true free lunch. And by free lunch, we mean trying to get to a higher expected return for a given level of risk, or conversely, we could say it a different way, lower level of risk for the same expected return. And again, the key there, we're talking about expected returns. I can't guarantee you what the actual return is going to be. So this is where, as long as we don't have two securities or two asset classes moving in lockstep, then diversification is a good thing, and it will help you in terms of risk and return. So bring into play commodities, your example. Absolutely, to the extent that that's not going to be perfectly correlated with stocks and bonds, then that in theory should help in terms of a diversifier. My reading of the empirical data is that the biggest bang for your buck. So let's start with 100% equity. Let's suppose I'm going to put all my eggs in the equity basket, and be it index funds or various other kinds of investments. I would argue the biggest bang for the buck you're going to get is probably adding bonds as an asset class. Beyond that, I would say that there might be some benefits, but not as huge as you would get by adding bonds. So now, let's start with go back to the 60-40 that we talked about. Instead of the 40% bonds, let's suppose I took 35% bonds and 5% commodities. Would that give me a better risk return? Perhaps, but it's going to be, I would argue, based on the evidence, it would only be a marginal difference versus that 60. So it's getting that in that really makes the difference.
Gotcha. I think the contrarian, the kind of rebuttal would be, well, if it's 35.5, of course it'll be marginal. I think they would think it would be 60-20-20 to give it like that fair offset versus what bonds would do. Just because I don't remember what the Barclays aggregate bond was. I want to say it was down like 11% or 12% in 2022. We're looking at gold. Gold finished unchanged. So, nothing to write home about, but that's where a 0 is much better than a -11.
Yeah.
Yeah. So, And kind of going back to some of the concepts of the book, I just wanted to ask, because this one, when I spoke with your publicist, this really kind of sparked my, it caught my eye, we'll say. You have a point in your book where you talk about Roman generals, the New York Mets, which I think we hit on with Bobby Bonilla, and then also Cristiano Ronaldo, and what these incidents, these moments can teach us about investing. Can you just kind of elaborate on what you're talking about there?
Happy to. So three different stories in the book, and I devote a chapter to a whole number of different stories that seem pretty eclectic, and they're all over the place, and that's hopefully what's the beauty of. So we go back to Roman empires. Let's start there. We go back to Quintus Fabius, and this is in 3rd century BCE. He had the unenviable task of trying to fight one of the famous Corinthian warriors, Hannibal, famously crossed the Alps with his war elephants, and was really ruthless and brutal, but was a really strong military commander. So this story focuses on Fabius, a Roman dictator who had to try to stop Hannibal. And so when they were in very close proximity, what Hannibal wanted to do was he wanted to fight. And what Fabius realized is that now was not the time to engage in a fight. He needed to bide his time to try to reinforce the troops. And so while Hannibal approached and was all ready for a fight, the response from Fabius was to do nothing. And so this became known as what we call masterly inactivity, which is really the art of knowing when to not do something. Fabius bided his time, and once reinforcements came, then he picked a better time to go to battle with Hannibal and to defeat Hannibal. And there are other stories as well. Another example, famous fight between Muhammad Ali and George Foreman, and how Muhammad Ali, who had long odds, eventually defeated Foreman, was what became known as rope-a-dope. And what Muhammad Ali did for round after round after round was basically absorb punches, staying against the ropes, and then bided his time, did nothing until he had this knockout punch. So that's one important investing lesson as well. We don't always have to take action. Sometimes the best course of action is to do nothing and bide our time. And this goes back to, again, active versus passive. So that's the Roman general story.
Interesting.
The New York Mets. We talked about Bobby Bonilla for long-suffering Mets fans.
Yep, that's me.
There you go. Yep. He was a very strong player back in the 1990s. The Mets traded for him, traded him away, and then once again traded back. At the time, he had one of the most lucrative contracts in baseball. And what this story focuses on was when the Mets decided to buy out his contract, which was a $5.9 million contract in the year 2000. And what Bonilla and his agent Dennis Gilbert were able to negotiate was a deferred compensation agreement. And that compensation agreement kicked in 10 years later and ran for 25 years. And you add up all the money that Bonilla has received for giving up that 1 year, $5.9 million, and he's still in the midst of it now. Yep. It adds up to $30 million. And so even if you look at the Mets payroll, I looked at this a few years ago, what Bonilla was receiving each year is around $1.2 million, which is more than a lot of the active players are making. And so
crazy.
It seems like a crazy deal, but yet what the story really tells us is the importance of opportunity costs. And so what drives the value of that contract? It was a good deal, but it was really a fair deal in many cases. And so we have to understand our own opportunity costs. And if we understand that, that's also what drives the value of bonds and stocks. So this chapter is really helping us to understand why opportunity cost is important and why we need to assess our own opportunity cost as well.
Yep. Yeah, and that's a good point because I think especially Mets fans, you see all the posts in the comments every year of, oh my gosh, we're still paying this guy that's not even on the team. Like, we're the dumbest team in sports history. How did we do this? But I guess if you look at the other side, which never seems to really get any attention, and the time value of money of, what did that save the Mets by retaining that year's payout back then for X amount of years? Like you said, maybe it's not as unfair as the optics allude to.
Absolutely, and the Mets came close to they had a World Series opportunity the year after in 2000. They weren't successful.
Yeah, yeah. I mean, maybe that's what helped them keep Piazza and stuff, and you don't hear all that much.
Exactly. I
Yeah.
just as an aside, I happened to be in New York on vacation recently and went to my first Mets game, and unfortunately I'm 0-1 for the Mets. I'm sharing some of
Oh,
your
we still got a chance.
absolutely. Very briefly, the third story you mentioned, and some of your listeners might recall this. This goes back a story that's just 3 years ago. Cristiano Ronaldo. This was at the 2020 Euro Cup, which was actually played in 2021 because of COVID. At a press conference, this was when Coca-Cola was one of the major sponsors of the tournament. And at the press conference, there were 2 bottles of Coke that were in front of Ronaldo. And as he sat down, he made a point of removing these 2 bottles of Coke and said, no Coca-Cola. And then he brought a bottle of water and said, agua, water, drink water, don't drink Coca-Cola. And on that day, Coca-Cola stock fell by $4 billion. And so on the surface, and many reputable media outlets, including the Washington Post, wrote up this story basically implying what an influencer Ronaldo was. By the way, he's the most followed on Instagram. He has the most followers, hundreds of millions of followers. So the story angle was what an influencer he was. He this one action caused the stock price to go down. And what I reveal is when you go behind the scenes, there's more to that story. And in fact, he did not cause the stock price to go up, and it had to do with what was happening at the open, and it had to do with when Coca-Cola was anticipating to pay dividends. So I'll let your readers who buy the book read more about the story, but it really comes back to causation versus correlation. And that's a really important story for all investors. Many strategies that certain fund managers follow really pick up on finding relationships that have happened in the past and expecting these relationships to continue on. Sometimes that works and sometimes it doesn't. We have to be really careful. In this case, there was absolutely correlation, but there was not causation. So we really have to be careful and assume that something is going to cause something else.
Yep. Yeah, that is one of my biggest pet peeves, is this kind of like this human need for cause and effect. And I feel like you see it every day in the media, especially, I mean, if you just open the Wall Street Journal or pick any media outlet, at 10 o'clock in the morning, the market opens down 1%, and they're saying market crashes because of X, Y, and Z. And then by 11 a.m., the market's up and market is roaring based on, and they just this constant, like, because this happened, the market went this way. That happened, the market went this way. And there's no accountability to that. Nobody can actually say, was that really what caused it or not? And it just seems to be kind of this story making that doesn't need to be there. And I can't stand that when I see clients or people I talk with that say, oh, Did you see Trump said this or Kamala said that, and then the market went that way? And I'm like, whoever said the two have anything to do with each other? But that's the way that we seem to want to make it.
I couldn't agree more. And I think the toughest job would be that Wall Street Journal reporter who every day has to make up a story in terms of what happened. I
Yeah,
thought that
I think make up is the key words there.
absolutely, and I've often thought that what really should happen, let's suppose it's on page 3, and this reporter has a particular allocation of what their column would be. I'd like to see that blank someday. Nothing really happened in the market to cause anything to go on. So let's not make up a story and just let's not talk.
Yeah, just kind of say what it is, not why it is all the time. It's just speculation. So I think to kind of close up here, Stephen, one thing that you mentioned in your book again are these 3 levers to reach your financial goals, which I think struck a chord because these are the sort of things that I'm educating clients on. And you mentioned how much we save and invest, how long we save and invest, and what returns we expect from. Can you kind of talk about those 3 items? Because I really do think that's like at the crux of financial planning.
Absolutely. I'm glad we're going to end on this. You're absolutely right. Those are the only 3 levers that we have. And I would say that for individuals, an individual can control number 1 and number 2. You can control how much you save and invest. Part of that is going to be how much you're prepared to sacrifice today and versus consume today. So that's up to you, and hopefully financial advisors can help provide guidance with that and help in terms of perhaps an individual's budget so that there'll be more left to save. So that's a personal decision. How long you save, obviously, if you're a listener and you're 20, that's going to be you're going to have a different situation than if you're 60 and what your horizon might be. But still, you have some decisions. Do I want to retire at 55 or 65 or maybe go to 75? So you've got some latitude there. The only other lever is once you decide to invest and knowing how much you're going to be putting in each year and for how long, then what matters is the kind of return that you're going to get. And so that really matters in terms of the asset classes. This is where it comes back to our discussions on things like 60-40 and what kind of expected return will I have in terms of stocks? What kind of expected returns will I have in bonds as well? So this is where it's going to come down to risk and return and what's assessing what your risk preference, your risk tolerance is going to be as well. And so that's where the assets and the investing really comes into play. And that's where you do have choices, but those choices will be limited on the other 2. The more I can save each year, the longer that I can save, then I don't have to take on more risk. I might have painted myself into a corner. If I'm not saving very much and I don't have much time, then I might be forced to invest in something riskier. And so it all comes back to expected returns and risk.
Yep. Yeah, that's often what I'm counseling people is get aggressive with your savings. That doesn't necessarily mean you got to get aggressive with your investing. That savings rate, how much we're putting in, that we are in control of.
Exactly.
And so last question I have to ask, and you can defer, you can plead the 5th if you want. We won't hold you to it. But that last lever that you talk about, which is, of course, the returns, as we air this episode or hold this interview, I should say, it's August 26th of 2024. So we have another, quarter ahead of us, plus a little extra time in the year and an election not far off. How do you think the remainder of this year will shake up in the stock market?
I will be bold and I will say markets will fluctuate. That's the only thing that I can assure you of in which direction. I particularly don't have a short-term crystal ball. So I'll leave it there.
All right, fair enough. All right, well, thank you everyone for tuning in to another episode of the Caderna podcast. I had the pleasure of speaking today with Stephen Foerster. Be sure to go check out his new book called Trailblazers, Heroes, and Crooks, Stories to Make You a Smarter Investor. And of course, wherever you're listening or watching, be sure to subscribe, and we will see you next time.